Hey, I'm Daniel Snyder, and on this week's episode of Week in Bite, we're joined by Katie Stockton, founder and managing partner at Fairlead Strategies. And we're going to be diving in with Katie about her market views and the Tactical Sector ETF that they actively manage, which has been outperforming the market since it was launched in March of this year. And there's an interesting strategy there that you should really pay attention to. So let's learn more and bring Katie into the conversation. Katie, it's so great to have you with us. How are you doing today?
I'm good. Thanks. It's been a lot of volatility to navigate, but we're hanging in there.
No kidding. And now, before we get into what makes the TACK ETF so unique, I'd love to start with, let's just, you're a big technical person. Fairlead's a very big into technical, and you have your indicators and everything else. I mean, from a general over market view, if we're talking about either the S&P 500 or the Qs, have we hit a bottom? Are we going up? Are we going down? Are you still in a full momentum downward turn? What's your opinion on where we are?
Yeah, I mean, that is the question, right? Like, have we seen a bottom? Are we close to a bottom? And I would guess no on both, quite frankly. It's a bearish message that I'm taking away from the charts right now. The momentum gauges that we track, some are as simple as moving averages, other more complex than that. But overall, they do point lower. And that's really most importantly from a long term perspective. It's something that we really haven't seen since 2008, unfortunately. And it's not to say it needs to get that bad, but the indicators are as bad as that time frame. And then before that, we'd have to go back to the 2000, 2002 timeframe. So we do have bearish indications from our longer term gauges still. And what we want to see this resolve in is some kind of basing phase. And that can be really frustrating because I think what we've become accustomed to is that these corrective phases end pretty dramatically. You get a bit of a spike in volatility and then it's over, right? But this doesn't feel like that kind of environment to us. We feel like we're in a bear market cycle. And the newer market participants who didn't live through that 2008 timeframe might sort of lose their patience by having to wait for that bottoming process. And I think that's a little bit of what we saw with the summertime rally when folks were kind of chasing that relief rally off the lows, and now, of course, find themselves, I don't know, maybe break even at best.
Now, you just mentioned the spike in volatility. I mean, obviously, we're seeing volatility in the market, but in regards to the VIX, I think right before we started, I was looking, VIX is around 24. Of course, we're filming this on Thursday. It may change overnight before this is released. What kind of are you watching on the VIX? Is it in an upward momentum swing? Are we going to get the spike that you're talking about?
Yeah, I mean, the spikes that we saw in those bear market cycles, was like 80 or 90 VIX. And here's hoping we don't have to see that. What we are looking for the VIX, we do believe it's in a high volatility cycle. It kind of is cyclical in that you see sort of these regime changes. And we do think that we're still in this kind of higher volatility regime for the VIX. There is resistance or previous peaks on the chart around 35. So at a very minimum, we are ultimately looking for the VIX to test 35. On the downside, the support's roughly 20 and obviously served as the footing for this most recent increase in volatility that we've seen since mid-August or so. So looking for a higher bias, hopefully not terribly higher, but I do think there is risk of that.
Yeah, and let's transition real quick because, just this week we saw the ECB came out. They pushed up 75 basis points on their interest rate. We're seeing crazy volatility within the currency market as well, which everybody's watching the dollar. Right, dollars at 110. It's going potentially higher. Do you think that's just going to see a continued upward momentum move, or should we be expecting a little bit of a pullback?
It is all about respecting momentum, and certainly the dollar does have positive momentum at this point across all time frames. We are looking for it to wane a little bit over the short term, and we say that because some of our counter trend indications on the daily charts are flashing signals that would support maybe 2 weeks of consolidation sideways to lower, that type of action, which is only natural in such a steep uptrend following such a big up move. So we're looking for neutral to lower near term for the dollar, but we would respect that long-term uptrend as very much having a hold and likely to yield a higher or a stronger dollar in the coming months, just as we've seen previously. Perhaps the uptrend moderates a little bit in its slope, but we are going to, sort of believe in it until it proves us otherwise. And then as it pertains to 10-year treasury yields, which we track very closely, you have seen the volatility there too pick up a little bit as this 3.25 level has come into play. That's an important resistance level for it. It goes back to the 2018 high. And it's a natural place also to see this kind of backing and filling, which would mean more sideways to lower sort of choppiness before ultimately we would expect some kind of breakout there. And we'd expect that breakout because the long-term momentum, of course, is to the upside.
Now, a lot of investors are looking at the stronger dollar. They're thinking through their head about the revenues that typically come from overseas for individual stock companies, whether it's from Europe or elsewhere. We're going to see, decreased exports for America. It's going to hit revenues. I think that's a lot of conversation we're starting to hear here at Seeking Alpha as well. I'm just wondering, from your standpoint, do you see any individual stocks right now from a technical side that might be setting up for this environment?
Well, collectively, I mean, our top down work, as you know, it tells us that we're in this bear market cycle. So we're out there working very hard, looking for ideas on the long side. And we really can't find many of them whatsoever because it's counter trend. Counter trend positions are lower probability. So where we found, I'll give you an example, an uptrend recently was in corn prices. So for those that might be interested in investing there, we highlighted an ETF called Corn or CORN as a long idea. But within the equity market, it's really difficult to find anything that feels high probability, except perhaps in the energy sector where there still are long-term uptrends, and a little bit more selectively in the utility sector, we're still seeing some uptrends there as well. Those are two of the best performing sectors in relative strength terms versus the broader market. Overseas, as you can imagine, we're seeing very weak relative strength versus the US. So the US still is the place to be globally in terms of relative performance, but unfortunately in a bear market cycle, the relative performance doesn't always really reward you in absolute terms. We highlighted a chart in our latest research of the German DAX, and there was no new catalyst to the upside or downside, but the downtrend there is really very pronounced. You saw lower highs, and that also goes in relative terms if you took a ratio of the DAX to the S&P 500. So that's the type of thing that we're seeing both in Europe and also in emerging markets.
Yeah, and that's a perfect way to transition right now. Let's get into the tactical sector ETF that you guys created, ticker symbol TACK. Obviously, you're investing in like treasuries and gold, and I mean, let's just start from the beginning. I mean, obviously, the goal is to outperform the S&P 500 in the overall market, correct?
That's right. So, I mean, we really want to participate on the upside, but protect on the downside. I'd say that's our primary goal. Think of it as a fund that is designed to take advantage of bull markets in US equities. And we do that by trying to find the best sectors in terms of their momentum and their relative strength. And we have a mechanism to do that that's based on our technical methodology. It's somewhat sophisticated, but it's based on a combination of momentum gauges, overbought, oversold measures, and relative strength inputs to arrive at the best of the best in terms of the sectors that we can invest in from a top-down perspective. We're using the sector spider ETFs to that end. And if the sectors aren't hitting on all cylinders, we then are willing to replace them with risk off categories. And for that, we're using short-term treasuries, long-term treasuries, and gold, or ETFs representing those. And with that exposure, we can minimize risk during downdrafts. And that's how over time it tends to sort of perform or outperform in a weaker tape, especially.
Yeah, I mean, look, you launched this ETF this year, as I mentioned, back in March. You're coming up on the 6-month mark. And within these 6 months, I was just looking earlier, I mean, the market is dramatically lower. And you have capital preservation, right? And as investors, I think we need to remind everybody, sometimes bear markets, sure, you can make money on the way down, or you can conserve capital. And it sounds like your ETF is the way to do that. Just kind of curious from here on out, I mean, should we potentially expect any rotation? I mean, we were talking about levels, right? We're talking about continued downward momentum, tactical ETF. If we're continuing to see potentially, what are we looking at? 3,500, 3,200, 3,000? How far lower we go? And is short-term treasuries and gold and everything that you have right now probably the best play for the near future?
Yeah, I mean, what we're thinking about, I mean, the S&P 500 has initial support around 3815. If that level is broken, the targeted support becomes about 3200. And that 3200 level is a key Fibonacci retracement for those technicians out there. And of course, with a move of that nature, we might even see the TACK ETF remove itself from energy and from utilities, which are the only two remaining sector exposures, and move fully risk off, which would mean essentially, a division between the short-term treasuries, the long-term treasuries, and that gold exposure. We've not seen that over the course of the model that we built. We've not seen that very often over history, as you can imagine, but I wouldn't be surprised to see that happen because those asset classes do tend to outperform the equity market during big downdrafts.
Yeah, I think my last question for you before we let you go here is, should we be expecting, from what you're seeing on the technical side of things, for the bottom to potentially hit this year, or are we looking at potentially next year?
Well, for me, it's looking more likely next year. I think between here and year end, we should have some kind of tradable low if you were inclined to put on a counter trend position, which is, of course, very difficult to capture properly. I mean, they tend to last anywhere between 2 and maybe 5 weeks. So you really have to be short term in your orientation. But I do think we'll see some kind of intermediate term, perhaps tradable low between now and year end. But that's something that will ultimately give way to perhaps another downdraft. I think the worst case scenario for the market would really be a slow grind lower, as opposed to that kind of climactic action that I think a lot of folks are actually sort of hoping for to signify the end to this bear market cycle. I suspect that we're in for a bit more of a prolonged and perhaps not highly volatile on the downside type of environment.
Amazing. Let's go ahead and leave it there. Katie, thank you so much for joining us today, and good luck on the continued success with TACK. We really appreciate it. You have a good weekend, okay?
Thanks so much. Take care.
And it's now time, the time you've all waited for. Let's get over to Seeking Alpha's Kim Kahn for next week's Catalyst Watch.
Thanks, Daniel. I'll get to the jersey in a second, but first we got to talk inflation. It's a very packed week of economic data next week, and that's the last full week of data that the Fed's going to get before its interest rate decision, the highlight being, of course, Tuesday's CPI. Morgan Stanley out today talking about expectations for a negative month-to-month print on headline CPI. That would be a big shift from just a couple of months ago, and for the headline year-over-year number to sink below 8%. That would suggest everything going in the right direction. But interestingly enough, if we had a big miss on the downside for CPI and a much tamer than expected number, it could throw a bit of a wrench into the Fed's thinking, because Powell was out today reiterating his hawkish talk that they're going to do everything they can to control inflation. So it could bring back a bit of the 50 basis point talk, but right now we're kind of cemented in 75. Along with the CPI, we've got PPI on Wednesday, and then don't sleep on the Michigan inflation expectations component that also comes out on Friday. Now, talking about inflation, you may have seen recently how much English soccer teams spent on players this summer transfer window. It was almost $2 billion. And next week, we've got Manchester United earnings. Full disclosure, I am a fan, yes, but I am not a shareholder. And I've always kind of been interested in these sports teams that go public in the shares, because they're basically arbitrage propositions. You're basically kind of betting against a buyout happening or not. And the Glazer family, who is not loved at all by the Manchester United supporters, has had rumored to be looking at offers north of maybe $4 billion to sell the whole club, but nothing concrete. Fans would be happy with that, but basically they want to see all the money not going to dividends. They want to see all the money going back in the team. So it's basically, you want your club just to break even. Tough if you're a shareholder.
Man, that's just those size and numbers are just, I can't even imagine. Just think about having $4 billion. Be like, all right, I'll liquidate and I'll buy a team today. Why not? We'll see what happens, right?
Yeah, and if you look what happened with Chelsea, and then they've got their new owner. They replaced a Russian oligarch. They got an American billionaire. He decided to name himself the interim head of sports manager, and bought all the players. Spent $300 million for a coach, and then fired the coach after 5 days. So it could be some wild times.
Yeah, it sounds like a prime opportunity though for some sports betting companies. They need
exactly.
They need to capitalize.
On who's the next manager fired and who's the next team taking over. Good odds.
Over and unders, right? That's all you need.
Yep.
All right, Kim. Well, go ahead and have a great weekend. We'll keep an eye on Man U next week. Thanks for the update.
Thanks.
Thanks for hanging out with us today, everyone. If you're interested in more market discussions, interviews with CEO of public companies, stock analysis content on companies like Meta, Apple, Coca-Cola, and more, then head over to Seeking Alpha's YouTube page where you can find all episodes of our original shows. That's What's Happening in the Stock Market with Mike Saul, Stock Market Live, and of course, this one here, Week in Bite. And if you're a podcast listener, feel free to check out our other podcasts as well and leave us a rating and review. And that's all for this week. I'm Daniel Snyder. Have a good weekend, and we'll do it all again next week. Take care.